All right, Anthony, we'll give people like a minute to
Yeah.
come in and then we'll get the party started. Hello, hello, everyone.
Still coming in.
It's still coming in. All right, I think we can kick
Ready
it
to
off.
kick
I
this
think the
off?
numbers are lagging. Yeah, so Anthony, will you take us away?
Of course, thank you. Good afternoon, everyone. I'm Anthony Rena here from NJBIA and wanted to just introduce myself to our New Jersey Business and Industry Association Business Growth Roundtable on this Tuesday afternoon. We at NJBIA are thrilled to have created this incredible initiative with an amazing group of women. For those of you who are new to NJBIA, we are the nation's largest statewide business association representing about 1/4 of all New Jersey employees. And NJBIA helps and continues to support companies here in New Jersey, and we are business at the center. We do also offer our customer development opportunities through our signature events throughout the year, our magazine and digital opportunities, our podcast, and our television show, Minding Your Business. And we also have a lot of money-saving initiatives for clients that are coming on board, such as payroll, healthcare, training, 401k solutions, and our 24-hour HR support. So again, I'm Anthony, one of the executives here at NJBIA. If you need any information, I'm going to drop my email and name in the chat, along with some upcoming events I'd like to share with you. We have October 21st. We have our next leadership series, session number 9. This will discuss digital leadership and innovation. We're going to touch on AI tools, tips, challenges, and of course, cybersecurity. And then towards the end of the month, we have October 28th and 29th taking place is our Energy and Environment Policy Forum. This is going to be at the Doubletree Hilton in Somerset, New Jersey, where we just had WBLF last month, which was an amazing event. So you'll have all my information in the chat. Please feel free to reach out to me for any sponsorative or any questions regarding NJBIA. And now I will turn it over to Rachel.
Thanks, Anthony. Hello,
Uh,
hello, everyone. I'm so excited to be here today. We have an amazing event for you. For those of you who don't know me, my name is Rachel Durkin. I'm with Paradigm Marketing and Design. We are a web branding, marketing, and sales enablement agency that specializes in working with clients with a complex sale. So if you have a sales team that requires more conversations to close deals, we can help them increase the number of qualified leads that they're meeting and conversations they're having and improve their closing rate so that it is higher and quicker. Now, before we get started, I want to do a few housekeeping items. So number one, we have a very, very lively, exciting panel for you today. There is a lot of content to cover here. I know some of you submitted questions early on when you registered, and we tried to pull as many of those out as we could to answer in our conversation today. But if you have questions as we go, you will notice there is a chat at the bottom of your screen and a Q&A. Please, please, please enter those questions in the Q&A. I encourage you to use the chat to introduce yourselves. This is going to be a networking event, even if it's virtual. Share information, make comments, but I am concerned that I'm only going to have time while we're talking to look at the Q&A. So we will do our best to answer questions live, but please put them in the Q&A symbol at the bottom of your screen. Also, I encourage you to introduce yourself in the chat right now to everybody. I see Anthony, you're already kicking it off, so thank you. Now, before we get started, next month, be sure to register for an event next month where we're going to talk about strategic partnerships and how to ignite growth in your business with them. So as the economy is changing and there's uncertainty in the marketplace and dollars are tight, partnership approaches can be a great way to expand your reach and attract new audiences to your environment by leveraging and sharing and collaborating with one another. So at this event, we're going to talk about the importance of choosing a partner who complements what you do, shares the same audiences you serve, and aligns with your value propositions, how to identify those partners, how to create strategies and SOP that you work together effectively, and best practices to maintain those partnerships so that you can all both grow your business together. Lastly, as my housekeeping items, I want to make sure I recognize our sponsors. So we have a new sponsor with us called Trusted Associates. They believe that no one succeeds alone. They built an ecosystem where innovation, collaboration, and growth thrive through their Empower Packs community and a range of solutions like masterclass, peer cohorts, and mentorships. Trusted Associates makes business growth accessible and affordable. Whatever the need, they are your trusted associates that you can turn to. I encourage you to check out the people arm of the company, Freeman Clark, which is a trusted associates brand. And in under 48 hours with their help, you can get a senior IT leader to join your team and deliver immediate results. They are fractional, flexible, and affordable. I will put their website address in the chat after this. And then I also want to recognize Summit Place Financial Advisors, who offers focused, individualized attention, serving a select group of highly successful people like you who have outgrown mass market institution. Success also brings complex investment, tax, and estate planning challenges, and they can help you. They specialize in working with clients of $5 million or more, and they are an SEC registered firm. So with that, and I am putting the link in for the registration for November's event right here in the chat. So be sure to register now early. And with that, I'd love to bring our panelists to the board. So can I have all of our panelists join us? And Anthony, thank you so much. All right, panelists, I'm going to give you all a chance to introduce yourself in just a second. But again, I know I'm beating a dead horse here, but please put your questions in the Q&A, and I will do my best to answer them live as we go. So I want to again welcome you all to our Business Growth Roundtable. We are talking about from growth to exit, how to command premium valuation for your business. Over whether you're planning to sell tomorrow, the next 12 months, or the next 5 years, there are steps that you need to take to maximize the value of your business. And there's a journey you have to go through as a seller or as a buyer in order to be successful along the way. So as business owners, we're facing a very dynamic environment, economic uncertainty, inflation, rising interest rates, and shifting markets that are creating new challenges. At the same time, we're looking ahead with the great wealth transfer expected in 2030, which will bring both opportunity and increased competition. I know some of you had a question about that, and we will address that today. The good news is that with the right preparation, these challenges don't have to derail your goals. In fact, they can make your eventual exit even more successful if you leverage them appropriately. That's exactly what we're going to talk about today. You'll walk away with insights into how buyers are evaluating businesses right now, what it takes to unlock premium valuations, and how to navigate today's financial landscape and how to position your company for success with the right sale. So with that, I'm going to ask our panelists to introduce themselves. I was going to introduce you, but y'all are going to do a way better job. So I'm going to ask you, Bobby, can you go first and talk a little bit about who you are and what you do?
Yeah, sure. I appreciate you having us on here. This is a great topic. It's super exciting, especially when you start to think about the business owners that have kind of put their entire lives into something that they've built that has become a huge part of their balance sheet. So, here we have a goal of getting 1,000 business owners exit ready by 2036. And whether they want to sell or they don't want to sell, that's kind of irrelevant, because being exit ready is just really having, I would say, your hands on the steering wheel, and you are set to really grow the business in whatever direction you would like to grow it in if you're exit ready, because the power ends up being with you instead of with the prospective buyer. And I think that most business owners, they have to sift through a ton of noise in not only their business, but understanding the elements around the professionals that can help them in this environment. And the last thing they want to do is really spend 5 or 6 figures on some sort of a solution that they don't really know is the right fit for them, but they've heard that it might be the right fit. So what we do is we come in as an advisor to them. It's really about finding the, I would say, issue spotting where there's issues, and knowing that when it's time to bring in people like Alan or Jason or Ron, because we've identified that there are issues that we can't particularly handle, we're bringing in the right team members to get them there. And that's the exciting part, is being part of that team and helping business owners get from their vision and where they are to preparing them for the future.
Fantastic. And you're also going to share a little bit with us today about the great wealth transfer that's happening and how that's going to impact us. Is that right?
Oh, yeah.
Okay,
Yep.
awesome. Jason and Ron, will you all introduce yourself, please?
Yeah, happy to. Thank you, Bobby, for that. Appreciate it. A lot of the work that you do is excellent and helps this process become more efficient as they come into the M&A landscape and begin to think about selling. But I'll tell you that most people don't do that. Most people are kind of out there on their own. And when they come to us, they really don't have a great idea of all the things they need to do to prepare their business for sale. So that's some of the things that we're going to talk about today. Ron and I are from Website Closers. We're an M&A firm. We own several firms in the space, but Website Closers is the largest, kind of focused on tech and internet businesses. But we also do a lot of other things like business services, et cetera. So we've been through about 2,600 transactions about 4 billion overall in deal flow.
Wow.
So from that perspective, I think we can provide a lot of insight into what we have seen through the years. Companies that are well prepared versus those that come to us that are in ill prepared mode. So that's a quick down and dirty on us.
Fantastic. And I guess with all those transactions, you might know a tiny bit about increasing valuation, just like
Just a little bit.
Okay.
Okay.
All right. And Alan, why don't you introduce yourself to the group?
Yeah, thank you very much, Rachel. So Alan Tepper, I'm a partner in a consulting firm called CFO Consulting Partners. We're a CFO and controllership consulting firm, and we provide CFO and controller services to the lower end and middle of the middle market. About a third to a half of our business is M&A related, and we've been doing M&A type related stuff since our founding in 2006. So I'm looking forward to this event, and I'll turn it back to Rachel. Thank you.
Fantastic. Thank you. So here's how it's going to work today. I'm going to start by guiding the discussion with these folks who clearly have no idea what they're talking about. No, I'm just kidding. You got a great group of people here and a ton of knowledge that I'm excited to dive into. The three themes that we're going to cover are going to be market landscape, preparing your business for sale, and how to maximize competition to command premium valuations. So after that, we're going to open it up to Q&A, but please, like I said, we're going to do our best to answer Q&A along the way as well. So if the topic comes up or a question comes up as we're talking, shoot it in the Q&A at the bottom. So with that, I want to start with the first section that we're going to cover, which is the market landscape and opportunity. So we're going to kick this off with the big picture. Today's landscape, interest rates, inflation, global events are shaping buyer behavior. I feel like every time I look at the stock market, something new and different is happening. So while certain industries are seeing strong demand and add in the upcoming wealth transfer that's about to happen in the next 5 years, opportunities and competition is incredibly significant. So we need to talk about what's happening in the market landscape right now. So Jason and Ron, as experts in this area, doing this every day, what are you seeing? Where does M&A stand right now?
Sure, I'm happy to get started. So what's very interesting to us is even though we are in sort of a geopolitical oddity for a year, we have not seen this level of demand on buy side since the days of COVID. It's pretty interesting, to see that a level of interest when you also have interest rates at 10%, 11% on senior debt, when mezzanine debt is sometimes over 20%. Yet people are coming in and they're hungry to buy. It's not uncommon for us to see 10 plus offers on a lot of our very good transactions. So from that perspective, I'd say the M&A side on the buy side is good. Now on the sell side, that kind of depends. So obviously in April we had a big shift geopolitically in our tariff world, and from that perspective, we went to 145% on Chinese tariffs coming in inbound tariffs. So from that perspective, we had a lot of e-commerce clients and retail clients and anybody associated with them sort of panic and stop buying, and they didn't know what to do. So we saw some of an issue there. Others in that space also are having issues because during COVID, they increased their inventories, they increased their warehouses, they increased everything because everything was so elevated, and now they're coming out of that. And they've still, tried to normalize themselves as they're coming out of it. And so this year was supposed to be sort of a breakthrough green shoots year, and really has been, except for we've been held back a little bit by some of these geopolitical issues. But a lot of the clients coming to us right now, they're very interested in retaining equity. They want to, they're excited about their business. They know they're in a position where they need to sell and they want to retain. And when you retain, of course, you have the opportunity to sell now. Maybe you sell 60%, 70, 80% of the company. You retain some equity, and we negotiate, strong tranches and puts and calls opportunities, for the post-closing opportunity there. So that's something that we're seeing a lot in the M&A landscape. I would say that, some of the larger transactions that are out there are just now starting to come back to market since the lows that we saw in 2023 and 2024. Larger companies are now coming back to market because there's so much demand. And when I say demand, I mean extreme demand. So the businesses that we put a business out for sale every day of the year, sometimes two a year, and we're seeing 500 NDAs signed in the first week. So you can imagine the customer service nightmare that it is on our side to try to manage that many buyers. It is lunacy to get back to that many people. You can't vet that many people. You can't deal with it. So what happens is all those people that miss out, they have fear of missing out, and they go into the next deal even more hungry. And then happens in the next deal and the next deal. And so we just continue to build this demand. And so now, people come to us and they're putting offers in before they ever speak to anyone. They just see the teaser and they go, here's what I'll do. So, are we in a bubble? I don't know. But I will tell you that this level of demand is something that we just have not seen in a while. And as far as interest rates goes, right now, again, we are seeing somewhere between 9 and 11%. For buyers that are looking to acquire companies, the best way to manage your interest rate and to get as close to prime as possible is to put as much down as possible. So for companies or for buyers that are putting down, close to 25, 30% in a deal, we've seen those interest rates as low as 7 to 9%. If they're fully collateralized and they're great buyers. So there are opportunities to get better interest rates, but a lot of people are shifting away and moving into more, going into ABLs and those kinds of asset-backed loans and those kinds of opportunities because they can do interest only right now, knowing that most likely interest rates are going to drop as the Fed funds rates drops next year. It is expected to drop considerably, hopefully in the next year. Those are my notes anyway. I'm sure everyone.
No, that's fantastic. And you mentioned you're getting how many NDAs when a company is put out for sale?
Yeah, a good 500 on the good deals. Yeah, we just have to shut it off. So usually we have about a week where we just have outstanding opportunities out there, and then we just have to shut it off and then start vetting people. And you just go by those that came in first, unless we already have a relationship with a buyer who's already purchased a business with us, who's already proven themselves to us.
And this is for companies that are making $1 million in revenue up to 50 million revenue. Is that right?
The last business that we put up for sale was a fractional CFO company. Listed it for 6x, went under contract for 6.5x because we had so much demand. Shut it off at 500 NDAs. We had 32 offers.
Wow.
Wow.
So it's like housing market.
And it was not growing. It was not growing. It was level. And again, so that's why I use the word bubble. If you see companies at those sort of rates, by the way,
you see the smile on Alan's face. He's like, see, external CFO.
Excuse me, I'm out of here, guys.
And to answer your question, Rachel, it was only about $1 million in EBITDA. So this wasn't, a 2+ million EBITDA capital markets transaction. This is a relatively small transaction.
Yeah. That's great. Thank you. Now, Bobby, talk to us a little bit about the wealth transfer. And we did get a question during registration on this, which I'm sure you're going to. How can you explain the great wealth transfer? How is that influencing M&A activity, and what business owners should be doing to prepare?
Yeah, so what's interesting is if you just start to look at, and we use 2030 as the timeline, and timeline of 2030 is because by the time 2030 comes around, every baby boomer is going to be over the age of 65. So if we look at where a majority of the wealth in this country sits, it depends on which publication you look at, anywhere from 50 to 85 trillion dollars worth of value. But it's roughly 3 million businesses that are basically set to transfer hands. And that's like planned or unplanned, it will go someplace. And the way that it's going to work is they're either going to evolve, they're going to transfer, or they're just going to vanish. And that's your baby boomers over the age of 65. The other tide that's coming in is AI is set to hit singularity by 2030. Now, the timeline was 2030, and it seems like the further we go in time, the closer that number keeps coming because of how quickly technology is advancing ahead of what the anticipated rate was, even just as short as 6 to 12 months ago. And for those of you, AI reaching singularity is essentially just saying the machines will be smarter than humans. So, Arnold Schwarzenegger looking for John Connor. I'm not saying that's going to be the reality. That's the Terminator reference, the 80s movie. For those of you who are like, what is this guy talking about? But those two are coming in, and they're coming in hot. So if we think about the traditional babyhood mentality, baby boomer mentality is they're the workers. They have a sense of of work ethic that is probably an entrepreneurialism that is probably greater than any other, from the traditionalists to today. And it was basically breaking the conformity of their parents and going out and creating all of this wealth. And they're also at the age where, and if I just think about like my parents and a lot of the clients that I have that are already in that older, baby boomer or even older than baby boomers, is the advance of even cell phones. We know that at first you can say, I don't want to deal with it. I'm too old. I don't need to do it. But eventually at some point, life, the normal functions of life are going to require you to have a cell phone, to be on the internet, to have an email, to now use AI. So if you think about those two tides coming in, you have 3 million businesses that are set to transfer, and there are a lot of baby boomers who are not going to conform to this AI. That is going to be a major pitfall in how they're going to evolve or transfer their businesses. So a lot of the preparation is really, the general preparation, which I'm sure, Jason and Ron and Alan will talk about, from a sense of getting your books ready, making sure your organization is set up. You have to go into the legality of it, all of the elements of the traditional getting your business ready. But if you're looking at 5 to 10 years as your launching pad before you're even thinking about it, because you're saying to yourself, I'll die in this business, or maybe, what my business isn't going to be really worth that much, or I'm going to leave it to my kids and hope that that remains the case. You're going to have to think about how AI is going to interrupt your business, and embracing it now and finding the ways that you can incorporate it to create efficiencies just makes it less and less scary, because like anything else, your knowledge base is going to start small, but the learning curve tends to get steeper the deeper you get into it. And that is the huge dynamic of this great wealth transfer that we're dealing with right now. Past, it used to be, I'll sell when I'm ready. And even then you'd get smacked on the back of your valuation, and you'd have to take a discount or a haircut because you didn't have your books correctly prepared. Or like I said, there's a litany of things that you want to make sure you prepare from a traditional standpoint. But AI is starting to play a bigger role in that. It's going to continue to stay at the forefront of the conversations with businesses that are looking to evolve or transfer.
So would
and
it
hopefully not vanish.
Oh, sorry, what'd you say, Bobby?
And hopefully not vanish.
Yeah. So would you all say that this is really if you're thinking about selling in the next 5 years, now is the time to do it, because buying is you're going to get a bazillion offers, and in 2030 there's going to be more coming on the market, or companies are going to shift so much that the whole landscape is that a safe assumption?
So I think, and that's part of why I set the goal out to be 1,000 business owners exit ready by 2036. And I said exit ready doesn't mean that you have to sell or you're gearing yourself up to sell. It really just means that you are ready to go. If somebody comes with a check and life circumstances is pushing you in the direction of needing to take a check, that check is going to have more money on it if you're exit ready than if you say, I'll wait until I have more clarity on when it is that I want to hang this out.
Yeah, that's great. So Alan, talk to us a little bit. Bobby mentioned getting your books right, or you get a haircut. Talk to us a little bit about the importance of EBITDA and the multiples and what to expect.
Sure.
And maybe Jason, you can weigh into if you're seeing
I'll get to the multiples and the EBITDA in a second, but getting your books ready is one of the key things that all businesses should be doing. Whether you want to sell now or sell 10 years from now. I mean, if you don't have a good set of books, start now. It makes a difference. We've seen situations where the deal gets retraded. The books were kind of messy, and the buyer didn't really feel comfortable, and the numbers kept on changing, and then the price went towards the very end. The price went down. Let me get to EBITDA and multiples. So one way that a lot of companies value businesses is on two factors. One is EBITDA, and the other is the multiple. Now, EBITDA is EBITDA. You're going to get an accounting firm to figure out what your EBITDA is.
All right,
There's
Alan, just
such
for
things as
those not
Oh,
those who are
earnings,
unexperienced. Yeah.
earnings before interest, taxes, depreciation, and amortization. EBITDA, EBITDA. So accounting firm can do it, other consulting firms can do it, but most consulting firms, accounting firms are going to come up with an EBITDA that's they're not going to be that much different. So what is the difference? The difference is the multiple. The multiple is, for an industry, the multiple is not like, if it's a fractional CFO firm, say the multiple is not 4.5, and it's always 4.5. It could be a range of 4 to 6 or 6.5. What you need to do, what businesses need to do, is position themselves so you're towards the top of the multiple.
Mhm.
And how do you do that? You need to be prepared for selling the business. You need to be thinking about, okay, what is the buyer going to be looking at my business? And when the buyer looks at my business, what are they going to be thinking of in terms of my value? So here's some value drivers that you need to be thinking of. So one is, as I said before, make sure your accounting and finance function is up to the task. Make sure they have accurate numbers and they can produce numbers on a timely basis. That's kind of like the entry level thing that you need to do. Another thing to do that's a value killer is, if you're the boss and you're making all the decisions,
Mhm.
probably not the best thing to do, because a buyer is going to want to buy the business and run the business. At some point, the boss is going to leave right away or later on. So you want to have a business that runs without you. You want to have a business that doesn't have a lot of, get rid of the risk. So if you have a lot of concentration risk, you only have one supplier, that could be dangerous.
Mhm.
If you only have 1 or 2 or 3 customers, that could be dangerous. That's gonna lower your value. You may have pieces of your business which don't really fit anymore. You may want to consider selling those pieces if you have time. You may have holes in your business that, if you shore them up, you'd get more value. So you may want to buy something before you actually sell your business. I'm going to stop there. There's plenty of other people that I'm sure have comments. So those are
Yeah.
my thoughts.
Yeah, I wanted to jump in there just for a second, and that was a great overview, very helpful. What I want to jump in on a second is just what, from a business brokering standpoint, what buyers and the banks behind them are looking at. So for us, if it's below, call it $8 million in enterprise value or purchase price, that tends to be, in the United States, an SBA transaction. SBA is capped at 5 million, but sometimes you can get additional funds, through banks to be able to do deals under 8 million. So we kind of had that break at 8 million is SBA below, and above SBA, above 8 million is, capital markets or private equity, family office, etc. When you're doing a deal under $8 million, there's a few things that you need to really make sure you're preparing for, really at the very beginning of starting your business. One is your tax returns. So when we run companies, all of us that run our own companies, what do we like to do? We like to save on taxes. But when we save on
I
taxes,
know what you're talking about. No.
no one knows. No one knows there. But when it comes time to sell your business, the question is, those write-offs that you included in your tax returns, are those going to be something that a bank is going to accept? Right? There are certain things they will. Things like travel, meals, cell phones, automobiles. I mean, these are the common kinds of things that are easy add backs, right? But what if you're someone who likes to save on cost of goods? You like to really play with the cost of goods, the amount of inventory, and when you recognize revenue. There's different things that you can do to make your tax return maybe not look quite so great as you're paying taxes. Well, that is counterintuitive to what you want when you're actually selling your business. Again, if it's something under $8 million. So, to try to, and some of you out there might not fully understand what that means. To fully understand that, you need to get with somebody like Bobby or Alan or us really early on, because even if you think you understand, or your CPA thinks they understand exactly how it needs to be done, you need to put it in perspective of M&A. What are banks going to worry about? And it can be very different from what a CPA might be trying to help you save on taxes, as an example. But if you save on taxes, then you're going to lose the multiple of earnings when it comes time to sell your business. And so it's really important on that financial side to understand that early on, so that when you start going through the analysis of financials for the banks, they get it. And just so you understand, if it's an SBA transaction, which I'd say roughly 90% of all deals under 8 million in America are SBA, if it's going to go SBA, then you need to make sure you have 2 years of tax returns that can cover debt service. That's what they call it, a debt service ratio. That debt service ratio has to be cleared for both 2 years prior to the execution of a transaction.
Yeah.
And Jason, that seems to be one of the biggest, I would say, the biggest hurdles that all of us face, because a tax accountant's job is to take the current year and reduce your income so that this way you continue to use that same accountant, because they're creative and strategic and can help you kind of turn those wheels.
Right.
And for guys like Alan, who's the CFO, who's looking forward and doing tax planning in the future, for all of us who are looking at the value of getting out, you really have to weigh what are the benefits of the current tax deductions versus the accelerated multiple that you may receive because your EBITDA is rich or your profit.
So let me just make one comment on that. So we see a lot of businesses on the smaller side where it's cash basis, and a lot of tax people produce their numbers based on their tax return. We feel that a buyer would be more interested and understand the numbers better if it was on a GAAP basis, GAAP, generally accepted accounting principles, or some sort of accrual basis, maybe not full GAAP, but some sort of accrual basis. So we recommend to our clients convert from cash basis or tax basis to an accrual basis. It makes the numbers so much easier to understand and explain. So I just wanted to make that point.
So real quick question, and then I'm going to move us to the next topic for time's sake. But Alan, someone asked in the chat, when you say multiple, you're referring to multiples of EBITDA.
EBITDA, multiples of EBITDA. Yes.
Now,
Yeah.
and let me just ask one other question. Jason and Ron, are you all seeing these multiples higher right now than usual as a result of the competition in the marketplace, or are they pretty average?
I would say normally they would be down because of the cost of capital, right? I mean, when you're paying 10% interest plus principal on a transaction, it becomes difficult to pay a high multiple, right? You mean you go too high on a multiple and you may end up having more debt service than cash flow.
Yeah.
But the demand driver counteracts that. And that goes back to what I said at the very beginning. We're seeing these green shoots on buy side that we've never seen before. And we're in the tech space, right? I mean, there's been plenty of times when we've had, accelerated opportunities. And right now there's, either it's because the quote unquote gig economy is kind of blowing up because we have people coming out of professional lives, or it's just because people really do want to become entrepreneurs. And maybe there's a little bit of fear out there about what might be coming.
Okay, that's great. So, okay, I'm going to keep us moving. We could talk about this forever, but I'm going to keep us moving for the sake of time. So we talked about the market landscape, and we did start to touch on this, but I want to talk more about what can business owners do now to prepare their business for sale. So from financial readiness to reducing risk and building defensibility, what are the steps that they should be taking to ensure that they are ready to go to market? So Alan, let's start with you on this, because you kind of got into it initially.
Okay. All right. So look, I think step one is start early, because what you want to do is you want to look at your business and say, what are my risks in my business? What is the buyer going to look when the buyer looks at me? What is the buyer going to say? And the buyer is going to look at a bunch of risks and things where they can beat down the price a little bit. And you want, as a seller, you want to get the highest price, but you also want your business to look as good as possible. So if you can get rid of and reduce some of your risks, that is probably the most important thing you can do. And if you can't reduce your risks, at least come up with a plan in terms of how to mitigate those risks. So maybe you can't totally reduce them, but this is what you're going to be doing to keep those risks from getting even larger. So start early. As I mentioned before, if you're the boss, make sure the business can run without you. Make sure your numbers are accurate and timely. And we love GAAP accounting. We love accrual accounting. By the way, you can be on a tax basis for paying your taxes, but you could be on an accrual basis for how you run your business. So we really suggest that most businesses be accrual or all the way to GAAP. And know your business. When you're trying to think about what your price is, you got to understand what your business is. What business are you in? And I'll just give you a very quick example. Take GM, they make cars. Take Tesla, they make cars. GM's valuation is probably, I haven't run these numbers in a while, so I'm going to but it's at least 10 times lower than Tesla. Tesla doesn't make as many cars. So just think about what business you're in. Tesla says they're in the tech business. GM says they're in the car business. Way different valuations. Okay, so know your business. And one more thing, be able to explain your business really fast. If you're spending 3 to 4 to 5 minutes explaining to a buyer what your business is, you don't really understand your business. You should be able to explain your business in 30 seconds, 45 seconds. People got to get it.
Or you need a good marketing agency, right?
Or you need a good marketing agency. Okay,
I couldn't help
done.
it.
I'm done.
That's great. So Jason, Ron, tell us a little bit about, when you're working with clients, what are you looking for to ensure that they're ready for sale?
Ron, you want to go through the attributes? You want me to?
Sure. We look for clean books. We look for sellers who are motivated. We particularly want to see, and some of these things Alan covered, but you want to see an infrastructure. You want to see growing numbers for sure. We have so many people that come to us that say, I'm thinking about selling my business, but I'm not sure now is the right time. A year and a half later, they'll come back saying, those numbers you talked about before, if you could get that for me, that would be great. But they're down 30%. And so a lot of it is timing. And, we really want to see that, you come to market at the right time. So, those are the things that I think are probably the most important.
Yeah, I just add a couple more things. I made some notes prior to here. I mean, some of the things that I see in the last 6 months to 12 months, these are the things that have come up the most. Those companies that have recurring or subscription-based revenue, we call that ARR, MRR in our world. People see that as a lower risk profile because you'll have that continuity of cash flow and business after a closing. And so that takes the nuance out of a transaction when you have that. Strong year-over-year growth, like Ron mentioned, you always want to sell when you're on the way up. And everyone's going to ask, well, how do you know that? Well, if you're on the way up, that's a good time. When you start leveling out, then that might not be the best time. If you have opportunities when you're leveling out, you might want to wait. But always be on the way up because, that's what's called a growth multiple. That multiple that we talk about on adjusted EBITDA. You want to make sure that you're maximizing that multiple at sale. And these things that I'm mentioning will help you with that maximum. Because like Alan mentioned, there's a range. It might run from as low as 4 and as high as 10. Where are you going to be in that range are these attributes that I'm talking about. Scalable infrastructure. If you have a tech stack or something that is your own technology, things that you built on your own, that is really helpful. That makes your company more valuable. I think someone also mentioned, don't be the person that's still running the company. We love quote unquote absentee owners. These are people that can claim that if I get hit by a bus, my company keeps rolling on, or I go on a vacation for 3 weeks, it doesn't bother my business at all. I just jump on a call once a week and we're good. Those are the very best kinds of businesses. And it's hard to do that when your cash flow may be as low as $300,000-$400,000 to hire a GM to come in and take 100,000 of that. It's a hard decision, but in the end, it'll make your company much more sellable and allow you to pull away and focus more on sales and marketing, which is really what drives all companies. Financial capabilities for a buyer. This is really, really important. So if you're below $8 million, your company's likely to go SBA. You need to talk to someone early about what is a buyer and what is a banker going to see. Are we going to be able to get SBA pre-qualification for this business? What does that mean, right? So start talking to people early on so you make sure you're doing the right things. Your write-offs, try to keep them out of COGS. Make them the most common things possible. Again, cars, travel, meals, and your salary and your benefits. Those are write-offs that are fine. Writing off COGS and, trying to come up with, writing off marketing and those kinds of things, it doesn't work out. Banks don't like that. Just running through these quickly. High customer retention and lifetime value. Again, there's so many different businesses out there who have recurring customers that come year after year after year, where the longer you have that stickiness, the more lifetime value or LTV that you build in and the lower the churn for that business, the higher the multiple, the much more valuable it is. Building moats. This is things like intellectual property. Everyone should have a trademark. No matter your business, always have a trademark. There's always a way to get a trademark one way or the other. Have one. If you have content that's valuable, make sure you copyright it. If you have devices or machinery, make sure that you're getting design or utility patents on there. All of these things help build value into your business. Those are the formulas we use when we start, putting a valuation on a business. Reducing concentration. Alan mentioned this. Super, super important, especially if you're in retail and you're in a business that has a certain kind of customers. If you have a customer that represents 40% of your sales, that's dangerous. That's a risk profile, right? So you want to try to allocate some of that to other people and try to pull it away. And finally, reviews and reputation. So when we sell a business today, the very first thing buyers look at are your reviews. Very first thing. They don't care about, the SIM that we put out or anything else. They go and they look at your reviews. What are the reviews of my company? What are the reviews on me as a seller? Because guess what? Every single customer that's interested in that business, they're interested in what you are as, what kind of person are you? What are your ethics? Are you a 2-star kind of business? I'm not going to do business with you. And why am I going to buy your business if you're a 2-star kind of business? So those are the things that I see as important attributes to drive valuation.
That's great. Thank you, Jason. And Bobby, I'm sure you've got some insights on this.
Jason, I appreciate you teeing it up just the way that you teed it up, because the reality of it is it's going to go back to something that Alan said, which these are all the elements and why starting early is so important.
Definitely.
Because it's not just one or two things. It's really trying to help to identify what are the lowest hanging fruits, and then how do we prioritize the things moving forward? Because no one likes change, right? You've got to go and you've got to make sure you've got this. I mean, we got 25 things from Jason alone, another 10 from Ron, another 10 from Alan. There's a long list of things that need to transpire or get accomplished in a period of time that, really is not forever going unless you don't have any plans of selling immediately, which is why starting early matters. So, when you start to think about all right, that sounds a lot. I'm out, overwhelmed. Mine's about to explode. Take me off of this because I'm just not even going to bother with it. It really is a lot easier if you have the right deal team around you to take you through the process of here I am, here's what I have. Now let's start to make these little tweaks. So when change transpires, because it's not only just change for the business owner, Alan put it perfectly. Jason followed it up. Your job, the American dream of owning your own business, is to have the freedom of time and flexibility. The baby boomer era really says time and flexibility to go and do more work. But the reality of it is no, it's the time and flexibility to do the things that you're really good at, so that this way you can hire that $200,000 employee that's going to bring in $4 million enterprise value excess of what you already are, because you're making the right strategic hires rather. And that change are all things that are happening below you. So you've got not only the change that you have to deal with as a business owner, but then the team that you have assembled that's running the business. And I think what ends up happening is for those of you who are overwhelmed, or maybe those of you who are like, man, I got to get going. I'm champing at the bit. Like, let's do this. It's a sexy process for somebody whose mind is stimulated by strategy and get really excited. The process of selling your business and making these tweaks and then finding how much better it runs over here than the way you had it over here, and how much potential money you're going to make or how many new ideas are going to get executed, that is really, really exciting. But the biggest thing that you have to work on as a big business owner through that process is not getting enamored by the sales process. It's running your business. So yeah, there's a lot to do, but we take it in little chunks so you can continue to focus on running your business, make the changes so you and the team around you aren't getting this culture shock of change. And then as we go through that process, whether it takes 12, 24, 36 months, you start to see the fruits of that labor really multiplied toward the end. And then it's just about keeping it going. So if 36 months turns into 48, turns into 5 years, 6 years, 7 years, well, you've created the foundation. You're there. It's your best growth strategy, which is the whole exit ready mantra that, I've been walking around yapping my head off that I think my entire team is tired of me talking about. But it is a lot. Take it, like eating an elephant, one bite at a time.
Just to add on real quick to that, and then I'll be quiet.
Sure.
But, to add on to what Bobby said, how you run your company, super important from the very beginning, because you could be running your company the wrong way, and it would cost you a lot when you get to the point where you want to sell if you haven't started talking to people early. So making sure that you are running your business in a way that makes sense for a buyer. And look, it might be 5 years before you want to sell, but if you have determined that I'm running my business at a multiple that's 8x because it's at its peak, it's doing wonderful, and that means you're making more money right now. And so whenever you sell. But if you have gone through this process to make sure that you're maximizing what would be a multiple at sale, you have to be making more money now.
Yeah, I don't fall victim, and I think people fall victim to this a lot, is everyone talks to everybody. Oh, I know a guy who sold his business, which is very similar to mine, for 8 times. And this offer of 4 times is unacceptable. I'm not going to do it. Well, at that time is really the moment where you have that conversation to say, this is what your business looks like. If you want that multiple, these are the things that we're going to have to do. And this is the timeline in which it will take, 2 years of tax returns means roughly 2 to 3 years is your prep time. I would argue 5 or more. But this is what you have to do to get there. Are you willing to do that? Or does it make more sense for you to take a lower multiple today so that this way you can kind of move on to the next phase or the next act of your life where you might find better purpose, more energy, more excitement, better value. So don't get caught up so much in what other people have gotten, because they may have started that process early. They may have put into place a lot of the right measures that needed to be put in place. So they commanded a higher multiple, and that's okay. But you're going to have to then negotiate with yourself of the time, energy, effort, and money that it takes to get from where you are to where you need to be. Is that worth the journey for you?
Yeah.
So team, I have some, the questions are flowing in. I want to, I also have in the chat some like industry specific questions, but I'm asking these people to send us their email address, and I promise that you guys would love to answer them directly for them after the event. But I'm going to jump into the third, and then I'm going to try to trickle some questions in along the way. So I'm going to ask you guys to speed it up just a little bit so we can get to Q&A. So we talked about the market. We talked about how to prepare your business for sale. Let's talk about how to command premium valuations and maximize buyer competition. So Bobby, in like 2 minutes or less, if you could start with that. I know you already started getting into that, but I'd love to hear a little bit more.
Just one element that I'll add to this, okay? A lot of times you're unilaterally focused, and this is where I'm sure Jason and Ron play a really, really integral part. We try to help with this, but the amount of transactions that they do and they see, I'm sure they've got a lot of value add to this, to this idea. But, if you're looking unilaterally at your acquirer to be exactly the person who's in your business that's just going to buy it to grow their business, a lot of times that's not the case. So sometimes from a conversation of multiple, you may be able to get yourself into a bidding war because you found a strategic acquirer that doesn't have access to the same client base that you have expertly curated. And they're in a completely like tangential business. And they may say, hey, listen, I know that competitors in your space will give you 5 times EBITDA, but I want access to your clients because that's not only worth what I can do to continue to run this business, but it doubles what I can do over here. I'm willing to pay you a higher multiple. And when you start to think outside of the box like that, on who really is going to value the different elements of my business, you know, Alan said something really interesting before, which is something we're always talking to clients about, is staying down Broadway. Sometimes you have these little tangents off of your business that make you some money, but they really just take up more time. They take away some efficiency. And it's like, you should not be doing this. And it's hard to say, I gotta have to get rid of this revenue in order to just continue to focus here. But the revenue opportunity and the multiple opportunity is greater if you focus here. You have to really take that into consideration as well. So, I mean, those are, I think really when you start to get into the, I want to sell, having those big strategic moments to sit back and look at your business and look at the landscape and really find who you can target outside of the norm may reap you better rewards.
That's great. Jason, Ron, talk to us a little bit about what you're seeing in the marketplace. How do we maximize the valuation?
Yeah, well, a lot of the things that I mentioned earlier about, you know, the attributes that drive premium, you know, valuations. I mean, those are the same things that drive, you know, a lot of people wanting these businesses. You know, if you have a high net margin business above 20%, you know, getting closer to 40%, you know, those kinds of businesses, you know, everybody likes those. High recurring revenue, that's really good. But one thing that a lot of sellers maybe don't think about that's really important as well is who they are, their personality, and how flexible they are in the process. And this is actually can drive 1 to 2 points of multiple in a business. We've seen this. You know, if you've got a seller that comes in and goes, it's my way or the highway, this is what we're doing. You know, some of what Bobby said, you know, my friend got 12x, you know, yes, it was a publicly traded company. And yes, the market cap was 2 billion, but, you know, I still, you know, think that that's what my company's worth, you know? So if you come in with that sort of mentality and don't listen to the people that are around you, and then you just assume that the people that are talking to you are just trying to sell you on something, that's not what we do here in our business. Our job is to make sure we're maximizing sales, right? So whoever you choose as a broker and somebody to help you prepare to sell, make sure you're listening to them and be flexible in the process. And when you actually get into the M&A process, be as nice, respectful, friendly as you possibly can, because those people get higher valuations every single time. And finally, when you're real quick, when you're thinking about how you're going to structure this business, make sure that you open up to the idea of potentially rolling equity. Because anybody that's willing to roll equity, what I mean by that is you keep a piece of the business after closing and you partner with the buyer after closing, right? That gives you 2 bites of the apple. So you can sell one tranche now, sell the other tranche down the road, or in several tranches. That gives you a huge opportunity, and it's exactly what a lot of buyers are looking for, especially in companies with at least $1 million of EBITDA and above. Sorry, Bobby.
So I was actually going to say, you know, be careful about those tail end opportunities because they could either work in your favor or they could blow up in your face. So again, with like, I'm going to get a higher multiple, but I've got to stay on for 2 years. I have to roll over this equity. And then you find out that you personally, to Jason's point, like you have to know yourself. I've been an employer for so long, and now for 2 years I have to be employee. And in order for me to get that money, I have to hit my bogeys. Being really true to why you're doing it is, I would say, a pivotal moment on whether or not you're going to be getting the multiple that you think you're getting, or you should just be happy with a lower multiple, but being able to either roll the equity and not be involved and allow them to kind of take the ship forward, or you just kind of wipe your hands of it and you move forward. Because the rolling of the equity and getting that, you know, second, third bite of the apple is very powerful. But when it starts to get tied into you being into the business for a period of time, you've got to really self-introspect on who you are and how you're going to operate under those conditions. Because I've sort of seen more of them blow up than I've seen kind of go across the finish line and everybody head over and start clinking champagne.
Yeah.
And
Yeah.
on that, I think the point that in addition to those points, there's multiple ways to do this. You can sell everything outright. You can sell pieces. You can partner. So if you're, if you're not quite sure what you want, I encourage you to talk to one of these guys to get more information. Alan, I'm going to turn to you in just a second, but Bobby, Jason, and Ron, and then Alan, when you're done talking, if you could put your emails in the chat. We've got a lot of questions here, but we've only got 5 minutes left, and I'm going to encourage everybody listening to reach out to anybody on this call. I'm offering you guys time for free. Don't get mad at me. And I'm sure they'll love to answer your questions directly. And I know there's some industry specific, and there's no pressure in asking for these questions. So, or asking these questions, and then I'm sure they're happy to answer. So, Alan, please give us in 5 minutes your feedback on how to maximize the valuation.
Well, look, I think so. We deal with businesses that are on the lower end of the middle market. So they may be having sales of 10 million. They could have sales of 30, 50 million. We have businesses that have much larger sales as well. But when you get to businesses, what we see a lot of businesses below 50 million in sales. I'm not talking about value of the business. I'm talking about sales. We don't see a lot of what I would call good financial planning and analysis being done. These businesses are not really doing what I'd like to see businesses do, which is have a strategic plan. Know where you want to go 3 to 5 years down the road. Follow that strategic plan up with a budget. Then measure yourself against that budget and be flexible and be able to, if you're not making your numbers, why aren't you making your numbers? But at least you have a vision of where you want to go. So if you want to climb Mount Everest, you need to figure out what's the path? What gear do I need? What risks am I going to run into? Those are the kind of things a strategic planning process will help someone do. That's going to help a business have a higher value because you're going to start making decisions earlier on and plan for things that's going to change your business over time. And so I like to see businesses that want to have a good, solid strategic planning process, understand their business. The managers of the business understand the business, and everybody's pulling in the same direction. I believe you're going to have a better business if you start that way.
Great, thank you.
You're here.
So,
Agreed.
So folks, we only have 2 minutes left. We had so much good content, and I know we could do another 3 webinars on this. I do know that Web Closers and CFO are doing a webinar in November, right? Is that right?
Correct.
And
Yep.
then Bobby, I'm sure you have another one coming up around this content in the next couple months. So we'll make sure that that information goes out to this list. I'm also going to encourage you to reach out to each of these guys for one-on-one questions. And I haven't talked to them about it yet, but I might encourage them to set up a follow-up session with live Q&A in the next couple weeks so that we can continue this conversation because there's a lot of interest here. So with that, we made it 2 minutes early. I'm not going to use the 2 minutes because we'll go over. But I want to thank each of you so much for coming. This was an amazing topic. I'm inspired. I'm sure everyone here is inspired. Follow-up content's going out. The recording of this is going out. Resources are going out, and I'll make sure your contact information is included. All right.
Right.
Thank you all so
Thank
much.
you so much.
Thank you.
Thank you.
Don't forget to register for our next month's webinar, and I'll see you all then. Thank you.
Okay.
Bye-bye.
Thank
Great
you.
job. Thank you.
Bye-bye.
Thank you, guys.